Welcome back. Time now for the word on Wall Street. Top investors watching you. My name, joining me now is Sanctuary Wealth Chief Investment Strategist Marian Bartels. Also with me is Infrastructure Capital Advisor, CEO and CIO, Jay Hatfield. Great to see you both. Thank you so much for being here. Marian, let me kick things off with you with a market that is under selling pressure this morning. Stocks, commodities, crypto, across the board. We're looking at the markets extending Friday's losses. All three major indices lower right now, fractional losses, although the NASDAQ is down about 0.75%, 194 points lower, after President Trump's nomination of Kevin Warsh as the next chairman of the Federal Reserve. January still closed out positive for the major markets. The major averages were higher across the board, even if just fractional moves in January. But I want to look at gold and silver right here because, of course, we had a historic gain and then a downturn on Friday from the record highs earlier in the week. They're back up this morning, although we saw selling on Friday. Gold price is now at $47.81, up 0.75%. Silver continues to be on fire. It's up 5% again, up to 82 and change. We are also looking at tech earnings this morning. We've got a number coming out this week. AMD is out tomorrow. Alphabet is out on Wednesday. Amazon out on Thursday. It's a lot for you to chew on, Marianne. Your reaction?
So, Maria, here's the good news. January was an up month, and so goes January, so goes the year. So if you use that model, we should be positive for the year. You know, the month of January just had so many political events. It feels like we've been through a whole year already. And I think that's a statement of how strong our economy is and how strong earnings are. We're in earnings season, as you know, and earnings are coming in really strong. We're up into double-digit growth rates. However, markets are extended. They're overbought. Sentiment readings are negative. So we could be in for a choppy period, and it's the midterm election year, and we tend to have volatility during the midterm election year. So we're telling investors to remain fearless. We continue to think that the S&P can hit 7,500 by the end of the year. As for gold and silver, yes, there's a lot of volatility, particularly in silver. It's very illiquid. There was a lot of leverage that was put in here, but we're still buyers. We think this is a healthy correction for any investors that did not have exposure, that want to have exposure. We think they're getting an opportunity here to actually buy into precious metals. So, you know, the net of this is, Maria, yes, we're going to have volatility, but we still think that these are great buying opportunities for investors.
Yeah, of course. Markets don't go straight up, but certainly we've got a good tone. Jay, what about you? Interest rates this morning has the 10-year right around, I believe it is 4%, 4.5%. Let's take a look at the 10-year here because the yield was on the move. It's at 4.22%. That is down just a half a basis point on the 10-year. 4.22% on the 10-year. President Trump, of course, nominating former Federal Reserve Governor Kevin Warsh as his choice for the chairman of the Federal Reserve. We'll see if there's some pushback because already we've got Tom Tillis in the Senate saying he's not going to move on this. You've also got the December JOLTS report coming out tomorrow. That's expected to show more than 7 million job openings. The January jobs report out on Friday. Expectations an increase of 64,000 non-farm payrolls, with the unemployment rate holding steady at 4.4%, Jay. And I know that productivity is on fire. Now, you had said earlier you wanted Christopher Waller to be the next chairman of the Fed. Tell us about Waller versus Warsh.
Waller, importantly, is a monetarist, so they think the money supply matters. The monetary base has actually shrunk 6%. And that's why we're very optimistic that inflation's coming down. But the markets are remarkably stable. Warsh is probably going to be the most hawkish Fed chair we've ever had. But the reason they're stable is that we're forecasting inflation rolls down hard this year. So it's not going to be so much about unemployment. We think more inflation coming down. We think that Warsh is optimistic about that, thinks that we're too high. So even though he's super hawkish, we're going to get to 275 to 3. That's why you've seen the bond market, Fed fund futures, super stable. There's a longer term concern that he might do what he did in the mid 2000s and tighten 17 meetings in a row and precipitate the great financial crisis. But it's not today's business. That's 3 or 4 years out. So that's why everything except these Mo trades and Bitcoin included is quite stable. And the market's hanging in there despite this surprise on the Fed chair.
So now, I was reading lots of notes on Wall Street. Most people expect the war would cut interest rates at least twice. So where are you on that? Are we going to see 2 rate cuts or 3, Jay?
Well, we're forecasting 3 because we're more optimistic than the rest of the street about PCE running down. We publish real-time PCE, so that reflects market rates available on the internet for the whole country, not just a little panel. And so it's at least 6 months ahead of the BLS, if not more like 1 or 2 years. So that's already at 2. So that's why we're more optimistic, not because we think the Fed chair is going to be super dovish in the short run, but he's going to respond to real data on the inflation side that will support lower rates. And that's why we're not, in the short run, concerned about the Fed chair nomination.
Any thoughts on tech here? Of course, this OpenAI deal with NVIDIA now in question. Marion, do you still want to own tech?
Maria, we still want to own tech, but we said that this year it was needed to reset. They had great gains. And what we're seeing is a broadening out in the market, which is extremely bullish. You're starting to see the value part of the market, financials, energy break out here. So I think we're in a temporary period where you're going to see value sectors outperform, but we still maintain that semiconductors and the AI trade will continue going into next year.
And real quick on hard assets, Jay, gold is up huge year to date, outperforming so many other markets. Would you put new money to work here in gold? And do you want to buy the gold bullion or do you want to buy the miners if, in fact, you want to buy some of these hard assets?
Well, certainly to the latter question, in our S-cap small cap fund, we have small positions in miners, which we did trim Friday morning. So it's okay to have some of the companies holding gold we think is riskier. We would like to, particularly for new positions, see it find a bottom. It was way weaker overnight than it is now. So we think there's better opportunities in dividend stocks, low PE stocks, low beta stocks, and not be in all these mo trades. I think that'll be the theme for the year. And so get into more value, income, reasonable PEs, reasonable PEG ratios.
All right, we'll watch it all. Great to see you both. Marion Bartels, Jay Hatfield, thank you.